A man wakes up, checks his phone, and sees his money go up by $3,000. He hasn't worked yet. He hasn't built anything. He hasn't even gotten out of bed. Somewhere else, another person wakes up and loses the same amount before breakfast. Nothing physical changed. No factories burned down. No new inventions appeared overnight. And yet, wealth just moved. That's the stock market. Not a place, not really a system you can see. More like a giant, invisible scoreboard where numbers change, and those changes quietly shape your life. Because whether you invest or not, the stock market decides things like your job security, your retirement, even how expensive your groceries feel over time. And right now, more people are tied to it than ever before. So let's strip it down. No jargon, no noise, just how it actually works. At the simplest level, the stock market is where pieces of companies are bought and sold. That's it. A company, let's say it makes shoes, decides it wants more money to grow. Maybe to open new factories. Maybe to expand into new countries. Instead of borrowing everything from a bank, it does something different. It cuts itself into tiny pieces. These pieces are called shares. Then it sells those pieces to the public. If you buy one, you now own a small part of that company. Not enough to walk into the office and make decisions, but enough to say, a fraction of this business is mine. Now here's where it gets interesting. Once those shares are out in the world, people start trading them with each other. Not with the company anymore, with each other. And the price? It moves based on one simple thing: what people are willing to pay right now. Not what the company is worth on paper, not how hard its employees are working, just what someone else will pay you for it. That's the first uncomfortable truth. The stock market is less about value and more about agreement. Imagine you bought a share for $100. If someone else believes it's worth $110, they'll buy it from you. Now, the price is $110, but nothing inside the company changed in that moment. No extra shoes sold, no sudden breakthrough, just belief. And this belief spreads fast. If enough people think the price will go higher, they rush in to buy, which pushes the price higher, which makes more people believe it's going higher. And suddenly, the price is no longer about the company, it's about the crowd. This is where the market starts to feel less like investing and more like psychology. But it's not completely irrational. There is a backbone underneath all this movement. Companies make money, real money, from selling products, offering services, solving problems. At the end of the day, a company that earns more money over time tends to become more valuable, because owning a piece of it means you're entitled to a slice of those profits. Sometimes directly, through dividends. Sometimes indirectly, because the company reinvests and grows bigger. So there are two forces constantly pulling on every stock price: reality and expectation. Reality is what the company is doing today. Expectation is what people think it will do tomorrow. And expectation is usually louder. Here's where things get strange. Let's say a company is doing well. Profits are up. Everything looks solid. But investors expected it to do even better. The stock can fall. Now flip it. A company is losing money. On paper, it looks weak. But investors believe it will dominate in the future. The stock can rise. This is the second uncomfortable truth. The market doesn't reward what is. It rewards what might be. And sometimes, what might be is wildly optimistic. If you zoom out, you start to see patterns. Booms, crashes, recoveries, again and again. In the late 1990s, internet companies with no profits saw their stock prices explode. Just having .com in the name was enough. Then reality caught up. Prices collapsed. Years later, housing prices soared. Everyone believed they would keep rising forever. They didn't. The system reset again. And yet each time, it feels different when you're inside it. Because when prices are rising, it feels like progress. When they're falling, it feels like something is broken. But the mechanism hasn't changed. Only the story people are telling themselves has. Now let's talk about how most people actually experience the stock market. Through funds, not individual stocks. A fund is just a basket. Instead of buying one company, you buy a small piece of hundreds, sometimes thousands. This spreads risk. If one company fails, it barely moves the needle. If the overall economy grows, your investment grows with it. This is why the stock market is often described as a long-term game. Over short periods, it's chaotic. Over longer periods, it tends to rise. Not in a straight line, but in a general direction. Why? Because businesses, as a whole, tend to expand. They innovate, they adapt, they find new ways to make money. And the market, over time, reflects that. But here's the part that rarely gets said clearly. The stock market going up doesn't mean everyone is doing better. It means companies are becoming more valuable. Those are not the same thing. A company can increase profits by cutting costs, reducing staff, automating roles, raising prices, all of which can push stock prices higher while making life harder for someone else. This is where the market quietly disconnects from everyday experience. You hear, the market is doing great, but your rent is higher, your salary feels stuck. And there's a reason for that tension. The market measures corporate success, not personal well-being. There's also a structural advantage built into the system. The earlier you enter, the more you benefit, because time amplifies everything. If your investment grows at an average of, say, 7% a year, it doesn't just add up, it compounds. Your gains start generating their own gains. And over decades, the curve bends upward in a way that feels almost unfair. Someone who starts early, even with small amounts, can end up far ahead of someone who starts later with more. Not because they're smarter, but because they had time on their side. This is the quiet engine behind long-term wealth, and it's invisible to most people until it's too late to fully take advantage of it. Now let's contrast the hype. You've probably seen it. People turning a few thousand into millions, charts that go straight up, stories of overnight success. But those are the outliers, the visible extremes. What you don't see are the thousands of silent losses, the trades that didn't work, the money that slowly disappeared chasing quick wins. Because the market has a way of rewarding patience and punishing urgency. It looks like a place to get rich quickly, but it's structured to reward those who stay longer than they feel comfortable. And underneath all of this, there's a deeper layer. The stock market isn't just a reflection of the economy, it influences it. When stock prices rise, companies can raise money more easily. They expand faster, hire more, take bigger risks. When prices fall, everything tightens. Hiring slows, spending drops, confidence fades. So the market doesn't just react to reality, it shapes it, which makes it both powerful and fragile. Because if belief shifts too quickly, the effects ripple outward, into jobs, into businesses, into everyday life. So what is the stock market really? It's part ownership, part prediction, part crowd behavior, all tied together by one moving number, price. And that price is always trying to answer a question that no one can fully answer. What is this company worth in a future that hasn't happened yet? Every trade is a guess. Some are informed, some are emotional, all are uncertain. And maybe that's the most honest way to see it. Not as a machine that prints money, not as a game you can fully master, but as a system built on expectations about a future that keeps changing. A system that rewards those who understand its rules and stay in it long enough for those rules to play out. But here's the part that should make you pause. If prices are driven by what people believe will happen next, and everyone is watching everyone else to decide what to believe, then at any given moment, how much of the market is based on reality, and how much of it is just trust?